Counting Superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. You've come to the right place. So this lesson is for students in their very first accounting class and people who are studying depreciation and fixed assets probably towards the end of their first class. And today's lesson is about gains and losses. It's an area that confuses people a little bit, but this is the second example here. So I've got another one. Both videos are pretty much the same, but if you want a little repetition, here you go. So Fred at Fred's snowblower service bought a thing called the contraption. And here's the contraption. All kinds of levers and pulleys, and looks like it's got an arm and maybe even a little face up there or something, but it's got, this guy's wearing nifty glasses. And what this thing does, it helps Fred repair snowblowers really fast. And that's because there's a lot of tools and this extra hand. So original cost. So this contraption was not cheap. It cost $35,000, but Fred is hoping to get a lot of use out of it. Who knows? He might be able to fix 2 snowblowers at once. Salvage value for this contraption is about $5,000. So at the end of the useful life, Fred's hoping to get $5,000 for this thing as salvage value. Useful life, 6 years. And I picked this out mostly to make the problem easy. So depreciation. How do we calculate depreciation? We're going to use the straight line method. Well, what you do is take the original cost, 35, minus away the salvage value. That leaves you 30,000. Divide it by the useful life, divide it by 6, so you get 5,000 per year. So let's come up with a little depreciation schedule here. So beginning book value is 35,000, so you put it right there. Depreciation expense is going to be 5,000. So the ending book value at the end of the first year is going to be 30,000. Take this ending book value and carry it to the beginning of the second year. Now the depreciation expense is always going to be the same. That's why they call it straight line. So there we go, 5,000, and the ending book value is now going to be 25,000. Well, we can repeat this process over and over again. Depreciation expense still the same, and 20,000. Take that 20 grand, drop it down into the fourth year. There we go. And we get 15,000. So the process just repeats and repeats. So here we go. Now, at the end of the 6th year, the end of its useful life, I've got the book value at 5,000, which is the salvage value. That's not a coincidence. We wanted it that way. We planned it that way. Now, what happens is Fred does sell this. He doesn't sell it at the end of the 6th year, but he sells it at the end of the 5th year. So he sells it when the book value is $10,000, but he sells it for $12,000. So he made a little bit of money off of this, a little bit of a gain here. So here's how we calculate the gain: is we take the original cost. Well, the original cost, we can get it right off the table here, 35,000. There we go, 35. And the total depreciation taken in 5 years, because he's selling it at the end of the 5th year, is $25,000. How did I get that? Well, all I did was take the 5,000 once, twice, 3 times, 4 times, 5 times. So 5 times 5,000. All we're doing is adding up the depreciation taken right here. So the book value at the end of year 5 is going to be $10,000. 10,000. So, and that matches the table right here. 10,000, 10,000. Look at that. They match. And that's good. It means we're doing a good job here. So the selling price at the end of year 5, well, he sold it for $12,000, folks. So let's drop that 12,000 in here. So he made a little bit of money here. Book value, 10,000. Selling price, 12,000. He made a gain. Fred made a gain. Now, gains are cousins to revenue. They're not revenue, but they're cousins. Now, you guys know, I hope by this stage, that revenue goes on the income statement, as do gains. Gains go on the income statement too. But revenue, that's money coming in from Fred doing his job. Now, selling these contraptions here, these crazy machines, that's not Fred's job. Fred's job is to sell snowblowers and repair snowblowers. This contraption is just helping Fred do a better job, a faster job. So we're going to call it a gain because it's money coming in, but not really from doing his job. So let's put in the journal entry, folks. So the first thing here is that Fred is collecting cash. Look at that. He's collecting $12,000 worth of cash. Also, Fred is getting rid of this contraption. Okay, so there's the contraption. And we have to write it off at the original cost because it's sitting on our books at the original cost. Original cost, 35 grand right there. And then we also have to write off the associated accumulated depreciation. Now, so far, we have a grand total of $25,000 of depreciation. So we need to get that off our books. And we debit accumulated depreciation to get it off our books because it's sitting on our books as a credit. So to get rid of it, we have to debit it. Now, if you notice here, 12,000 and 25,000, that adds up to 37. And as a credit, we only have 35. So we need another 2,000 to make this all balance. And that, folks, would be our gain right there. There you are. All right. Well, let's look at a slightly different example. Well, what if this Techaplexer was sold at the end of year 4 for $3,000 instead of 12? Well, I'm going to split the screen so we can see a little bit easier here. So what we'll do is we'll pretty much use the same information. So the original cost of the contraption was $35,000, the original cost, and the total depreciation taken up to the 5th year is $25,000. And so the book value at the end of year 5 is $10,000. There you go. And folks, that's exactly what we got up above in the previous example. Now the selling price for this contraption is only $3,000. So it looks like Fred kind of lost some money. According to the books, it was supposed to be worth $10,000, but Fred sold it for only $3,000. And it's often the case that the book value and the market value really aren't the same. So we fix that by having a loss of $7,000. So we are going to consider this a loss. All right, so how's it go in the journal entry? Well, Fred received cash. Here's the cash, and he got $3,000 for this thing. We also have to write off this thing. We have to get it off of our books. So we have to get rid of the Techaplexer here. There we go. And it's sitting on our books at the original cost, which was $35,000. So we got to get it off our books because it's no longer around. Fred sold it. So there we go, Techaplexer. And then what we have to do is take the accumulated depreciation to date. So accumulated depreciation, and that was $25,000 right there. All right, so if you notice, on the debits, we have 25 and 3,000. That adds up to 28,000, but we have a credit of 35, so we're off a bit. Well, the amount that we're off by is the loss. There we go. So we'll call that a loss. Now, losses are cousins to expenses. They're not expenses, because expenses, that's money going out from doing our job. Well, our job is, well, Fred's job, we should say. Fred's job is not to sell contraptions. It's to sell snowblowers. So this is kind of a peripheral type of thing happening. But anyways, there's the journal entry. So I hope this journal entry helped you guys out and made this concept a little easier. And check out accountingsuperstars.com. Got all the videos there. Listen by topic, hit the like and subscribe button. That helps the channel. So until next time, over and out.